This is Matt Godleski with Stewardship Financial Advisors Investment Committee, bringing you this week's snapshot edition of The Pulse. Here's what we're watching this week. Stocks set their sights on all-time highs as fiscal stimulus looks unlikely in the near term, while Treasury yields rise with economic data surprising to the upside. Global equity markets continued their climb this week, with the S&P 500 approaching the all-time highs of February on improving economic data and ongoing support from investors. Despite setbacks on progress for a new economic aid package from Congress, markets appear confident that the virus is relatively under control and that the reopening, along with prior stimulus measures from the Fed and U.S. government, is enough to keep valuations elevated. Bond yields rose this week as well, as investors shifted out of fixed income assets for more risk and additional debt issuance was absorbed by the market. On the vaccine front, Russia announced their vaccine is being rolled out to its citizens, though serious doubts remain over the efficacy or safety of the inoculation. Most political pundits now believe the next round of stimulus may not be agreed upon until September, as both sides are jockeying for political wins leading up to November, while American citizens pay the price. Beneath the surface of headline stock market numbers, rotations in and out of potential winners and losers from the ongoing pandemic continue, with virus data the biggest driver of daily swings. Market participants are glued to their screens, parsing through infection rates, testing data, and fatality rates, and the effect they have on the mobility of U.S. consumers. The reopening process will dictate the success and profitability of companies over the coming quarters, with over 30 million Americans now receiving unemployment benefits and earnings on U.S. corporations estimated to contract over 30% this year. Despite some respite this week in unemployment claims, with less applying and more falling off benefit rolls, there remains a long way to go to return to pre-pandemic levels of employment. That, along with the potential for school reopenings to lead to a surge in virus cases, have led to the pandemic beneficiary stocks, namely technology and healthcare companies, to continue to outperform. Meanwhile, those firms most sensitive to an economic restart are facing ongoing headwinds, but could rally tremendously off of low valuations if a successful vaccine is effectively deployed. This disconnect has led many to fear a bubble could be forming in those growth stocks that have led the market higher, and that other areas of the market need to participate in the gains for the overall market to move higher from here. We generally agree that companies with the most to gain from a reopening are perhaps the best opportunity at this time, though deep fundamental research is necessary to find true value and to avoid purchasing low-priced stocks that deserve their current prices. Despite all the optimism that abounds in stock markets today, we are more cautious on the outlook from here. Technical indicators do appear to be supporting markets higher, but fundamentals remain consistently disconnected from current equity prices. Either investors are in for a rude awakening should reality not live up to expectations in the coming quarters, or the record amounts of stimulus are proving enough to keep the liquidity-driven rally going. Our preference remains to be neutral on our stock allocations, as we see significant risks to the current run, particularly as we move into the fall with schools reopening and the election nearing. That said, there are still pockets of value where prices appear reasonable, and we're continually adding to those opportunities. Thanks for watching, and check out our website to read the full version of The Pulse for more details.